Live streaming is on.
All right, good afternoon, everybody. Event Trader back on with you here, and I am, of course, joined by Brett Manning, chart trader for the 7 a.m.
Howdy.
Flow Show. Howdy to you, Brett. How are you doing today?
I'm doing pretty good. How you doing, Gav?
I'm doing good, doing good. I guess we could just kind of kick off here. I've got a short on, and I know that would be that's an anti. That's against the trend for sure right now. But I'd be curious as to your thoughts on it. I'm assuming that you're going to hate it, but my thought was this: we're a little bit overextended on the run up here. And I was really curious to hear the Fed speak this morning,
Me
where we
too.
had Logan and
Jefferson.
Jefferson and Bullard out, right? Bullard, not a surprise, I would
Right.
say. Logan, a voter, did find that to be surprising, as she's generally been a little bit more on the dovish side. And so, we saw expectations for the CME Fed funds futures jump higher in
Mm-hmm.
reaction to it. It's running at about 30% now for a 25 basis point rate hike, which was about 10% just 1 week ago. Now, my thinking on the short was this, but we were starting to break down a little bit. Again, I felt that we were a little overextended on the trade to the upside, and we've got PAL out tomorrow at 11 a.m. And just kind of seeing some of the
Mm-hmm. I
comments
get
coming
it.
from Fed officials. I was looking for maybe a little bit of profit taking going on in front of Powell. People kind of reflecting back and having that PSTD around the Jackson Hole speech.
PTSD, sure, right?
So that's kind of what I was looking at. It looks like there's a good chance I'm going to get stopped out here. But I guess my question for you is the Fed speak. Do you find that maybe it could also, because I thought it could be a positive. Maybe they're getting,
I saw your argument. Yeah.
the messages that, hey, this debt ceiling debate, we've got this under wraps. I think we're closing in on a deal, and therefore the Fed feels a little bit more confident speaking
And their sense of the
hawkish.
banking system. You
And
can
they're
take any, you can package any one of
for
those
sure.
issues up and say, if they're willing to be hawkish now, they must know what's going on backstage. And so that may be a good sign about lots of stuff.
Right, which
I
is
get you.
obviously the counter argument here. So I'll be watching this trade, and I'm probably going to get stopped out here momentarily around 13,800. If you
Mm-hmm.
want to save yourself a couple points, close it out here. I'll ride it out and see if 13,800 provides any sort of resistance for now.
Where's your
And
stop?
13,805.
805. Oh, it's going to
So
be tough.
yeah,
Go.
it's going to be real tough. I mean, one hiccup
Hey, I
and
mean,
and
it's
I'm
a
out.
reasonable construction of a trade.
Yeah,
You're kind of paddling upstream there a bit, but yeah,
paddling upstream, and I was aware of it. I just want to have something on because it made sense to me, and I still think that we could see a round of profit taking going on in front of Powell just for the reasons that we laid out. But there is that bullish argument too, in terms of, like Brett and I were just talking about, maybe they knew something that has them feeling free to talk a little bit tougher about rates.
I just
So
think the main thing that you're like the main thing that you're up against with any, I mean, eventually it's going to run its course, but just malpositioning, like there's just
right,
egregious malpositioning, and that really becomes an issue when you start to get the movement. Like in a range, nobody's penalized. But when you start to get that upside movement, and the Nasdaq's fully broken out, and the
yeah.
S&P is just one more notch from breaking out, and if you have just people are just in a position where they're going to have to panic into some kind of more balanced exposure profile historically, and
Right.
that's a process, and it's just like it's tough to see how that's not got several stages to that process.
Well, and again, that kind of worked into my thinking of going after the Nasdaq too, Brett. Because
It looks the most, yeah.
if you're caught on the sidelines, are you chasing the mega cap like everybody else, or are you looking
But
at
what if
the
you're
B?
short them?
What's that?
What if you're short them?
Yeah, if you short them, you're having a bad year, right?
You're having a tough time. You're gonna have a bad time. Yeah.
But yeah, so I mean, yeah, there's certainly that aspect of you short them, but like I would think and this is what my thinking was on this, that we wouldn't necessarily see a big fall off on the broader markets and the S&P in particular, that we just see money moving back down into that beaten down energy space and financials. So
Could happen.
but well, let's break into the sentiment and flow show then, Brett, and chat a little bit about some of the things that we're talking about here, and look at some of the backdrop. Starting off as per usual with the AAII data. Now, this interesting week, we saw a downtick in both bullish and bearish sentiment. It's not that infrequent that we see that. The last time that we saw such a move would have been the week of April 12th, which would have been going on in front of earnings season. So I guess, Brett, in watching this data, do you find this kind of normal where we're coming up to a big event, Q1 earnings season back in early April, this time around, the debt ceiling, where people just kind of want to move to the sidelines to get a little bit more neutral than having a bias?
I think
and across choppy range too.
There's no question that's part of it, but then you also got to have the context of, bullishness moved to 15 percentage points below the long-term average, and bearishness moved down to a point where it's 13 percentage points above its long-term average. So, like, in the context, it's still a massive skew toward bearishness, even with this shift, massive skew relative to historical norms in terms of where people think the market is going. So neutral's up, but it's not through the roof. I've seen neutral at 50% before. This is 37%, and just bullishness at under 23% after, the market's held up and held up and held up and starts to leak higher. It's just interesting.
It is. And there's one thing. We talked about this in the last sentiment and flow show, Brett, and we'll just show you. There's kind of the weekly changes there. It's about 700 basis point drop in the bullishness. But this is what I found to be interesting, Brett, when I was just kind of going through the historical data. And one of the things that was really jumping out to me was I'd looked at it and I was like, okay, so we've had 13 straight weeks of that bull bear spread in negative territory. So I was kind of scrolling back, and the one thing I noticed, 78 of the past 81 weeks going back to November of 2021 have been negative.
Yeah, and that's just weird, right?
It's weird.
But the last time we saw it, it was mid 2016, something similar. And that was coming into Brexit and everything else. We saw something similar. We saw a similar stretch, and you know what that led to?
Yeah, no, a big rip higher. But like, I guess what we were talking about last time was, and that would be if you're looking at this on an annual basis. In August or in 2016, the bull bear spread averaged 29% at that time. It was the first time. It would have been it was below the long-term historical average in 2015 at 33%. And then it slowly crept up. It was 41%, if you're curious, on average in 2021. So this 27%, that on just looking at it on an annual basis, is the most bearish we've ever been in this survey. 1966 was at 27.6%. 1957, it would have been at 23% on average, which so I guess it just begs the question: is this simply the new normal in terms of the bearish outlook? The world's falling apart, all that stuff.
Yeah, but it still has implications for markets. Like, if you want to call it that, it still means it's harder to short than buy. Like, it still means that you've got, if people feel that way, they're not long.
Are you sure about that? We have this discussion.
Well, there's an interesting question, right? Does this translate through to positioning? In my opinion, it does.
Right, but a lot of the times you also talk about that not working out so much for the fund manager survey, or if we're looking at what's the one that comes out.
No, there's a different issue there. There's
fair enough.
Let's hear it. Okay, so if the fund manager survey, if they say, I think the most crowded trade is the dollar is long, that doesn't mean they're long the dollar. In fact, it probably means they're more likely to be short the dollar because they're stating what they think other people are thinking rather than stating what they're thinking. See what I'm saying? Like this is a statement of what people are thinking. This AAII survey. Do I think the market's going to go up, down, or sideways over the next year? That's what I'm thinking. It's not asking what do you think too many other people are thinking, which gets in that next kind of, it gets in that sort of hall of mirrors brain loop which makes it a little bit more difficult to disentangle. But in this case, it's just raw. It's like, what do you think the market's going to do? And in my opinion, if you take the data at face value, these are the honest opinions of these people answering this question, then when it sits at massive, bearish readings for 8 months, probably you have a market where a lot of active retail investors are positioned either short or neutral in the market rather than, aggressively long. And we see the same thing when you move up the chain into pro money. Look at the recent fund manager survey. We're going to look at this, but look at that cash level. It's back up to 5.6% as the market rallies. Like that's weird. That's extremely unusual to have. 2023 is going great for the market, really, and they're at 5.6% cash. And if you look at during normal times, 4.4% cash is usually cash heavy. And so to be at 5.6% cash, when you look across all this professional managed money, that's literally trillions of dollars just sitting around and not being put in play. So you've got retail and pro money that's just persistently doubting that this market can go higher. And maybe they're right in terms of what the world's going to do, but that's not our point on this show. It's just we're pointing out what people are positioned for. What people are positioned for is not a rally, and it continues to be the case.
Right. So we'll move along. I did get stopped out here, Brett. I'll post it to the site in a little bit. But it's just really interesting to see how bearish this sentiment's been going on now for the past year and a half, really, at this juncture. So, all right, moving along. Let's talk a little bit about some of these market characteristics, Brett. NASDAQ has obviously been the top performer. You've been pointing out the breakout that's been going on there. A lot of concentration, and we'll show some of the stats on this in the mega cap tech area. We did see breadth improvement over the past few sessions, which
except for one day. Tuesday was just ridiculous.
Right. Tuesday was
everything was red. It was amazing. The market was up
except for the mega
everything
cap. Yeah. I mean, even today is pretty impressive. When I was looking at the NASDAQ up over 1% in the advanced decline line in negative territory, I mean, that pretty much says it all.
Right.
We had the senior loan officer survey. Showed tighter financial conditions. Not a big surprise. Brett and I talked about it immediately after the Powell's speech and how he kind of highlighted that was likely coming. So a lot of that was around the banking crisis. Naturally, higher rates having its own effect there. Keeping an eye on S&P 2023 earnings, and we'll go into a little bit deeper detail around the earnings later on in the show. But that remains around 220, which has us trading at about 18.5 times or so in the S&P at this juncture and moving higher, obviously, with the markets edging up. So FY24, that's really been unchanged at $242. So that is basically has us close to more the historical range around 17 times. And, there's a lot of people that would argue, given the liquidity that's in there needs to be a historical reassessment of what an expensive market is.
But so you're saying that right now, the way that earnings season is going, we're at historically normal areas in terms of valuation?
No, I'm saying right now the valuation historically is a little rich, running closer to that 19. It's 18 and a half, 19 times right in that
but if
range
2023 plays out as expected, then
if 2024, if we don't see downward revisions from earnings, like some sort of earnings recession that drops that, say, 10%, right? An average recession, I'm just throwing the recession number out there, is down 13%, right?
Okay.
So let's say we see companies start to rein in their earnings by, just for argument's sake, 10%, right? That brings in FY24 estimates to
I gotcha.
215.
But if
And
that doesn't happen,
if it doesn't happen, then the market is in the historical range
okay,
right
17
now for
times.
valuation. Yeah,
If the S&P doesn't rally from here and they don't reduce their earnings estimates, then we're normal valuations.
correct.
Okay.
Or if you look at and they start revising earnings higher, costs of shipping their products go down, whatever the case may be, supply chains improved, so they're not paying up. Demand's weakened, so costs are down on some commodities, then that could move up, right? Then we're looking at a cheaper market. So, but the bottom line is, for right now, there hasn't really been too much movement on that, which is important because that was one of the caps and one of the feathers in the caps of bears, that these were going to have to be reduced down to that 200 level, and therefore
Yeah.
the market was just ridiculously expensive at that.
I just have to kind of go back to, like, I think it was like two of these ago, two sentiment and flow shows ago, we had a conversation about historical analogs, and I suggested 1994. There's a lot that kind of syncs up there, and the idea being that it's like you could explain how you've got this kind of market sentiment, but a market that's holding up. And if you look at the auction system for understanding stock pricing, that it's like the market's pricing in some kind of boom that's yet to become obvious to everybody. And that would be, I suppose, emerging technology like, artificial intelligence, etc. Just kind of shifting what's normal as far as expectations about productivity, et cetera, et cetera. So there's that analog. Doesn't mean it's going to happen, but when you went through that period, you had a lot of people. Sentiment was terrible in 1994. In 1994 and early 1995, the equity index futures had, I think, their highest short interest ever. And it was just this, and that was the sort of Greenspan soft landing. I don't know if you remember that, kind of like he put a flag in that one. And managing that soft landing. And really, it's about opening up trade with, the fall of the Cold War and everything. And we had a huge demographic dividend. And then Netscape was 1994, and you've got the huge internet boom. There's so many factors coming together there that made it tough for the market to sell off, no matter how bad people could try to position a narrative around all sorts of factors. And what we got was just this massive squeeze for 5 years after that. I'm not saying that's what's going to happen now. I'm just saying that there's a lot of similar characteristics between what we're seeing right now in terms of sentiment and positioning and technology and what the market feels like to me.
Yeah, no, that makes a lot of sense. So, would definitely be a good blueprint on trying to figure out where things are going, I would say.
Things were overvalued in 94, 95.
Right.
They just became way more overvalued for the next 6 years. Like that, that's what we did. We started off from overvalued and then just went into crazy places.
Which tends to happen, right?
It tends to happen when people think that it's a different world, that you're portaling into a different universe where the rules of the past 100 years don't matter. They don't apply because some new technology is going to change the game.
Yeah, you got that with Bitcoin. Certainly, the expansion of derivatives. So there's a lot that's AI, right? So, okay, well, continuing on here, some of the other characteristics. Money's starting to move off the sidelines, but sentiment remains very cautious. So we are going to talk about the cash levels going up, but some of the inflow data that I've been seeing from the Bank of America flow data that they release on Fridays has certainly pointed to some money sliding in off the sidelines here. Couple of the other areas too, looking at JP Morgan sentiment surveys. So we are starting to see some money bubbling into the markets, and that's been evident with, of course, the recent price action going on. So still remains very cautious and a lot of money on the sidelines, as Brett was just talking about. So far, reaction of Fed speak and economic data, Brett, have been very muted. over the last couple of weeks, I would say. I think that the econ data has just been so mixed, people really don't know what to do with it. And we will take a look at the Citigroup Economic Surprise Index and kind of view what's going on there. And then the other thing that I've been noticing here, Brett, is the dollar starting to pick up steam. I've been getting a lot of alerts from on my euro charts as that breaks down below the 108 level. We got the dollar up to 103.60 in the Dixie. This would be the highest level for the dollar since we'd have to go back to end of March when we were trading there, right around March. And remember, that would have been when things were cooling off around the tensions of the what you call it, the bank worries, right?
Sure.
So one has to worry, is this rally in the dollar just simply a safe haven buying in front of the debt ceiling? But whatever the case may be, it's had a big break above the 50-day moving average over this week, and just rallying pretty aggressively, up 0.7% on the day. And on the flip side there, you got the euro, despite some pretty hawkish commentary coming from euro ECB officials, has just been diving down. And the other one too that I've been seeing a lot of weakness in, Brett, is the Chinese yuan, which is back over that $7 level. I don't know if you've noticed that going on in the
Sure.
backdrop, but
well, though I will say the euro's up a lot over the past year. Like
it
you know, if
is
you kind of
without a doubt.
yeah, I mean,
It is.
and this is a little dip inside of what has been a really big spring off of that parity level.
Yeah, I mean it's a 2% decline over the last 2 weeks or so.
In the context of a 12% rally.
Yeah, fair enough. But the dollar, just keeping an eye out on that. I think that's been weighing in on the commodity space. So really, one of the things that I wanted to just point out with that is, if we do see this debt ceiling resolved and we do see the dollar all of a sudden start slipping lower, that could be a boost for some of the commodity names.
Sure.
Gold,
Right.
oil, they've all been getting hit pretty hard as the dollar's rallied. So definitely want to throw that on the radar. Is there anything that I missed here that's jumping off the page to you in terms of that needs to be mentioned, just for overall broader market characteristics?
I mean, I would say that the main one you missed here is just this has been, I mean, crazy trading range. Like this has been
Yeah,
the
very very
S&P.
tight consolidation.
As of yesterday, the S&P was at exactly the same price it was at during the last couple of weeks of March. And in between, it didn't go anywhere. So it's not like it did a big round trip somewhere. It just basically it got to somewhere in late March. And by, mid to late May, it's in the exact same spot with no movement whatsoever. And that has implications for how people approach markets. I mean, that's a long period to go nowhere. That's a historically significant kind of sideways, extremely tight trading range. And it suggests that there is a, I don't think that it's a boring nothing happening. I think it's a violent fight happening, and there's going to be a loser, and that's going to matter.
Okay. Right, because I mean, anytime you get a coiling like this,
Yeah,
it tends to spring in one
you
direction
see
or
the
the other.
opposite after.
Yeah. All right. So that's kind of what we're looking at going in. So let's break down some of these slides here. First, we've talked a lot about market breadth. Continues to deteriorate. This is a chart here from Morgan Stanley, where you could just kind of see that equal weighted index versus the cap weighted index, and that just is on a pretty steep decline there. We saw something similar back in May 2021 through the beginning of 2022. So you got any thoughts on this breadth issue? Does that worry you at all, Brett, or are you more of the mindset that we'll see some catch up in other areas?
I mean, I guess I would fall into the second category. But what I think is interesting is so the last conversation we had on the air, we talked about, I think one good point was just like, how do you invest in ChatGPT? You buy Microsoft, like there's
Right.
no stopping this train of there's a few companies that control all the next gen technology. And if this is a bull market, that's going to be powered by technology revolutions, there's going to be a lot of little acquisitions along the way. So if you
I don't
find the
think there's
right,
going to be any acquisitions along the way if you're watching anything that Lena Khan's up to with the
oh well,
FTC.
okay, but it's not happening. This is still happening.
Yeah,
Like there's a lot of words going on, but what we're seeing is the markets discount the notion that there's going to be, basically 4 companies that rule the world, and that's what's happening, regardless of what people are saying, and they've got all the money, and it's like clubs. They're 4 clubs where people have consolidated resources to control the game-changing technology of the future, and right now they've got the money to do that, as well as defend themselves politically, etc., and it's working. And they've got a global reach at all fronts, and I'm not even value judging that. I mean, I guess I could make a case that that's a problem, but leaving that aside, it's just that's what's happening. And if we're breaking into a new kind of era technologically, which I think we definitely are, over the next 10 years, this is going to be a new defining, shift in terms of how everything is done. And if that ends up ultimately being, the usual suspects in terms of the equity, then this chart doesn't scare me that much, because it's not the same world. This doesn't mean the same thing for the market's ability to persist in its rally if it's just bigger umbrellas. But again, one would assume that there's going to be more consolidation, because there's definitely going to be a lot of blades of grass that get above the soil line with something new that's useful that gets scooped up. So
as a historian, Brett, do you find any sort of rhyme to the Nifty 50 at all with this
yeah, I
sort of
don't think it
price
was
action?
possible to do the same thing that we can do now. I mean, in terms of just the organization, the scope of how you can run an organization today, the real-time way that you can coordinate so many more people and resources. I don't know if that was really possible in the late 60s and early 1970s.
Yeah.
I mean, the Nifty 50, for people who don't know, that was a classic example of a breadth problem in a market, where you get this playing out until it basically can't anymore, and then it's like the hollow tree.
Once that collapses, everything
Once that's the
else.
tree, there's nothing in the tree. The whole thing falls over. Yeah. So it's just, that was the bark. But in this case, I don't know if you can quite say the same thing, because you're talking about companies that are just, there's so much inside of that umbrella that you could, if you broke it apart, it would be a lot of different really successful companies, and they just happen to be coordinated under a single share symbol.
All right, moving on. Again, just going for a broader look at the markets here for the market characteristics. But the Fed balance sheet, that remains elevated here. You can see we were starting to roll over at the beginning of the year there, starting to slide off as the Fed was doing its wind down of the balance sheet, its QT, but then have that little pop there, as we could see, and that would have been right around the banking crisis, as the Fed was kind of forced back into action and buying assets. But we do see it going back down again, which is a positive, obviously, for the banking crisis, a positive read through on that, kind of harking to Brett's earlier comments about the Fed speak and them maybe knowing something. Certainly one of the key items that they've been talking about is the idea that the banking crisis is under control. And I'm just going to go through 2 more slides here, Brett, just kind of group this whole conversation here. The velocity of money supply here, we're just kind of keeping an eye out on that. That has ramped back up as well. So, we're just kind of watching this. This is on a quarterly basis going on. So
But I would also say, in the context of this, we have 12 straight months of month-over-month declines in CPI.
Correct.
And that's an important disparity between, look at this chart and that fact.
Right. Obviously, tough comps go into that too, though, right? So, I mean, just if
Granted.
you look,
granted, but
Just as you're looking at,
we're talking period over period, though, not year over year.
right.
Month
This
over
is the
month.
period. This is the period over period chart here.
Yeah, and so
So
I'm talking month over month CPI, not year over year. So
right. And then we got here the core services X housing, which is also on the decline. But you could see all these charts do remain elevated. So I guess this kind of feeds into what the Fed's talking about, Brett, in terms of where we stand on their tightening process. They still got a lot of work to do, and we've heard that line a lot. So when you're looking at this, do you think that there's going to be more of a natural decline on some of this liquidity here that's still in the markets? I know you've talked a lot in the past about the bath or the trying to squeeze the beach ball under the water, right? When you just have a pool of water there and you're trying to push it down and it just keeps popping back up because there's so much liquidity. Do you find that that's still kind of a running issue in the markets at all, or do you see this starting to slowly work its way out and looking for more of a precipitous drop moving forward in some of these charts?
So I think there's multiple issues here. One of them, the liquidity is still high for sure, but there's also a very real structural labor shortage situation that has a lot of different sources, and this is gonna keep being a battle. This sort of super core services side of things, it's gonna keep it's there's nothing you can do with monetary policy to battle it. It's largely demographic. You've got people who are living longer, who are retired. You've got a terrible demographic dividend situation, and a lot of people who were in that situation were close, retired during the pandemic, and they're not coming back. And they've got, passive income on a monthly basis, and they've got a nest egg, and so they're going to continue to supply demand into the economy for services, and they're not going to be available to be hired. And so a greater share of the economy than is historically typical is in that situation. And so you've got a smaller and smaller percentage of the economy that's going to be both producing and consuming, and a larger percentage of the economy that's going to be consuming but not producing. And that's just going to get worse and worse. And we've got a huge sort of deficit on the immigration side over the last several years. And that's, I mean, we're talking about like 3-4 million people. And then you look at the people who died from COVID. And you take all those things, you add them together, we've got a structural labor shortage that's going to remain in place for a while. And that's, the Fed knows this. Powell's talked about it. It's just part of the equation. And it's not really something that you can do too much about with monetary policy. And it doesn't affect the entire economy. It's targeted as far as who it affects. But it means that for companies to keep doing what they're doing on the services side, they have to increase wages for people to attract the number of employees that they need until we get, I mean, there's a lot of possibilities here. If you're looking for the next 5 to 10 years, the technology kind of alleviates some of this, because, we live in a world where pretty soon being a waitress is going to be a remote work possibility with a tablet. I'm not even kidding, man. You've got a tablet sitting in the middle of the diner table, and suddenly there's this girl who pops up on it, says, "What do you guys want? Here are the specials. This is what you'd like, blah, blah." And she's working from home. I'm like, that's going to happen. There's a lot of things like that are going to happen. Remote driven Ubers are going to happen. Once you start opening up a lot of the services sector because services are uniquely defined by a problem with geography. Like there has to be people in you, like within a few miles of you, that you have to be able to hire. And there's a lot of other industries that don't have that problem. And for hairdressers and waitresses and et cetera, that's just a fact of life, but it's becoming less so. And it's possibly going to become sort of geographic agnostic through technology. But right now you have a problem with a structural labor shortage that's going to remain in place, and it's going to be a long-term issue. It doesn't really have to do anymore with the pandemic, and it doesn't really have anything to do with monetary policy. So it's just a factor. It's just a coefficient in the equation that's going to make it harder to deal with inflation. But I don't think that it's necessarily like a canary in the coal mine for the whole rest of the equation, if that makes sense.
Okay. All right. So moving on the discussion here. Here's the CPI rates falling, Brett. But also expectations for short-term rates falling. So we were just talking earlier about the kind of surprising headlines from Logan. And Bullard, not so much. He's been viewed as one of the more hawkish members. Jefferson was generally mixed in his commentary.
Mester a couple days ago too, same thing.
And Mester a few days ago, yeah. So also viewed as one of the more hawkish members, though I would say, as well. So market's obviously not braced for another 25 basis point hike. How do you see the headlines playing out? Again, we got Powell tomorrow, so it'll be interesting to see what kind of water he tries to throw on this rally. Are you looking at any sort of sell-off in reaction to this as a buy the dip? Or how are you approaching the chance of a 25 basis point rate hike?
So I kind of, what day was that? I think the day was, I'm pretty sure the day was, maybe that's November 10th. I think it might have been, where we had this kind of situation where the market was starting to strengthen a bit. I'm not sure that was the right day. There was a day when we had Powell talking, and we kind of were sucked into this narrative of and it's something that we were sucked into for a reason, because throughout 2022 it happened where the Fed clearly demonstrated that they believe that equity market strength is part of a grand equation of easing financial conditions that will make inflation tougher to beat. Like, there was that narrative firmly in place. In fact, the Jackson Hole speech really put a dagger in that. Like, that was put a flag in that. Like, that was the capper on that one. Market had been ripping into that, and he was way more hawkish than people thought that he was going to be. And it was very clear that it was kind of like, the Fed can't have everybody feeling, flush and just not saving and going out and spending a lot, or else we're going to be in a world of trouble. It's basically like every day up on the S&P to them was like a rate cut. And they got to watch out for that. And there's a lot of, there's a lot of research in that direction. And so we've had a few days over the last few months where people are expecting that, and Powell's in a position to do that again, and then he doesn't. You know what I mean? Like, we had a huge breakout. And I think, again, it might have been the 10th of November, but it might have been a different day. We had one day where everybody was just waiting for this slap down from Powell. And he just opened. He was just like, you were probably done. Inflation looks fine. Everything looks really rosy. And the market went up like 4%.
Yeah.
And
that just ripped the Band-Aid off of it.
Yeah. And I wouldn't be surprised to see the same thing tomorrow. I mean, especially after, again, 12 straight months of month-over-month declines in CPI. And, I don't know if he's going to be doing what you've heard coming out from other Fed members. It's possible. That sticks in my mind, that moment, because it was so dramatic. And I wouldn't be that surprised, unless it's just really this sinister kind of streak in him, is to do that and then 2 days later say they're going to hike rates and just try to catch everybody, so that they just learn to not buy. I don't know. I mean, because it kind of happened that way last time. It sort of opened the floodgates, everybody went piling in, and then the Fed turned, maybe a week later.
Yeah, so it'll be interesting. I'm really curious to see what he's going to have to say tomorrow. That's for sure.
Because, I mean, you look at how we're flowing into this. It's very much like, you feel this sense of worrying about people kind of getting ahead of themselves, and financial markets acting effectively as, a conduit for financial easing. And, you lose the rate cut from the credit tightening because lenders start to lend more. Everybody's feeling flush. People start to spend more. Savings rate drops. Businesses hire more. The whole thing just opens up because, risk assets are pricing better, and credit is more available, and everything else. And that's, if they're worried about, losing control of inflation again, right after they get to this point where it looks like they've, started to win the war, that's kind of, there's a feeling there, I think, that maybe they're kind of in that position. And yeah, it's going to be really interesting to see how he handles that tomorrow.
Okay. Here's an interesting slide. This was from Morgan Stanley. They were looking at market returns post hike, so kind of flipping on the other direction. And basically, how they broke it down was whether or not inflation was elevated, right? And they had 3 episodes of rate hikes in 69, 73, and 81 that had the elevated inflation, and then the rate hike cycles in 89, 2000, 2006, and 2018, where we weren't seen as such. You could see when there was an inflation involved, there was a pretty nice return over the following months to come, about on average over a 3-month period, 5.9%, 5.8% over 6, 7.3 over 9, and 7.9 over 12-month. However, when inflation was elevated, the returns aren't nearly as good here, probably because uh, the rate hike cycles, I'm assuming, Brett, I didn't go back and check this, were a lot more aggressive than what we saw when there was an inflation. And I'm assuming that factors in here. But you could see the returns much worse when inflation is higher. So from this chart, does that give you any pause on anything? Does that make you wonder about something in terms of a 3 or 4 month period out from where we're trading right now?
So it's a great chart. I just think it's meaningless. And I think there's a lot of charts like that can get made. And so I just don't think that, and that I'm not taking a position on the outcome. I just think that this kind of way of coordinating data into this, really open and shut case about a particular dynamic is like you're skating over top of some really important ideas. Like the type of inflationary situation we have now is very different from what we had in the 1970s. And all the data points there, 1969, 1973, 1981, are kind of related to the same sort of festering tumor in the economy. And what we have now is, I would say, a different kind of dynamic going on. And I don't know if it's really apples to apples there. But I get the point that they're making. And I think, yeah, you've got people having being effectively acclimated into a situation where they have got a lot of faith in price stability resolving in the right direction when the Fed stops raising, versus a period where people are, constantly seeing the Fed trying to get things under control and then losing it, and there's always the sense that it's just going to come back again. And there was so many instances like that in the 1970s where, the Fed hiked and hiked and hiked and it got things under control, and then they stopped hiking, and then a few months later inflation upticks a lot, and we're right back into the situation again. And the faith that people have in those controls it was probably a really big part of what's on this chart, rather than the absolute level of rates, or even the pace of change of rates. And I'm a big believer that the pace of change of rates is a huge factor. But in this case, I just feel like it's a little bit apples to oranges to say that what we're going through right now can be compared to what was going on in the 1970s.
Right. I mean, just going back to the market breadth there, in the 1970s, all the major companies were, maybe not all of them, were directly tied to commodities, and inflation was a much bigger impact than, say, on a Google or
there were
a
union
Microsoft
deals
or
with
an Apple.
directly linked to CPI, and there was all sorts of things that were different.
Yeah. Okay. Moving along then. Next chart up, Bank of America Fund Managers Survey. Items of interest in this: investors remain bearish. The Fed is done. Risk assets resilient as long as the landing is soft. Cash levels remained high at 5.6%. Bond allocation at 14-year highs. Commodity allocation at a 3-year low. Global growth expectations at 2023 lows. 63% though we're seeing soft landings. 61% said the Fed hike cycle was over, and then the allocation of stocks at a 5-month high. So we're going to go through a number of these charts here. Quick thoughts, Brett, on anything that I just ticked off on the B of A overall look.
No, I mean, I think I think the cash level, to me, given B of A's data among their sample, the cash level has probably been the most important data point that I take from them. And 5.6% is just whopper. Like, it's way outside of historical norms. And so that's, if you've got, some of the biggest fund managers in the world all sitting with, let's say, 1.5% more cash than they historically have had on hand, it doesn't sound like much, but that's a lot. And if the market starts to rally persistently, that's just a huge amount of, just to normalize that, just to normalize that data point in terms of how those portfolios are normally structured is just a massive amount of buying that has to happen. And it will happen under duress of a rally and benchmark pressure.
Okay, we are just getting a little push higher into it. I see one headline crossing. Brett, just keeping an eye on that. A spokesman for China's Washington embassy said that ministers of commerce and trade reps of U.S. and China will meet next week in Washington. So we continue to see scenarios of where there's some thawing going on between the two sides. So that's obviously would be a positive for the global economy here. All right, so let's take a look at some of these slides here, Brett. This is from JP Morgan, equity positioning. You're just talking about it there. You could see this question is, are you more likely to increase or decrease equity exposure over the coming days? And it's only at 35%. You can see all through 2021 and 2022 is kind of bouncing around that 50 to 70% range for the most part, and then the decline really started precipitously in the middle of 2022, and it's really been on that side there. But this kind of points to your positioning, right?
This is a contrarian indicator.
Exactly. So when we're looking at that, you're basically looking at it as, okay, there's a lot of people still with money on the sidelines that haven't put it to work yet that are going to have to need to jump off.
Well, if you get the better world, at some point reality has to play along, but it's vulnerable. If the market just keeps kind of grinding higher, and then we just kind of get the sense that we're not headed for some devastating turn of events over the next couple of months, then this is a lot of buying that has to happen. It just has to, or people are just giving up on their careers.
Yeah. All right. And
again, it's not at the prices they wanted.
Yeah.
It's a bit like a squeeze, what I call a flat squeeze. Like you get the flat squeeze effect. It's just as painful. If you're mandated to be staying with your benchmark and you're way behind and the market just won't pull back and give you what you want.
And here's another way of looking at it, this equity positioning, which is the question is, what is your current equity positioning or sentiment in historical terms expressed from most bearish 0 percentile to most bullish 100 percentile? You could see 20 to 40% really houses the majority. 44% of people are in there. There's a couple of people that are uber bearish here, I would say. And then you kind of just get that slow decline going into the 40s.
But let's just assume that what this really means is if the curve was barbelled around the bulk of it being at the 50th percentile, that means it would be historically normal. Right?
Yes.
Isn't that how you're interpreting it? So
correct.
When that bulge is below that area, it just means we're malpositioned.
Under-positioned.
Yeah, right.
And
obviously in the late 2000s, in the late 1990s, it probably would have been, barbell toward the top.
Right. Here's risk levels, kind of just reiterating that too, Brett. Risk levels very low down. You can see where we were nearly below 2009 levels here at the moment.
Which would have been nice to buy.
Exactly. Here's growing pessimism just around the strength of the economy. Probably factors in a little bit to expectations for interest rates as well. But I guess this can be all seen in equity positioning where people are really concerned that we're just going to kind of run into that brick wall here, right, Brett?
Yeah, right.
All right. But with all that growth and pessimism, a soft landing is kind of the base case scenario. Does that surprise you? It seems like kind of a juxtaposition on those two areas there where, you have the growth pessimism, but then there's the soft landing. So do you kind of read that as, if you're looking at it on a strict basis, yeah, growth is going to slow down, but not too bad? Is that kind of how you view the responses in these two surveys when you take them cumulatively, Brett?
I guess, but you kind of need the the longitudinal data point on that. I mean, maybe 27% thinking a hard landing is the likelihood is, egregiously high. Like, you got to contextualize that. You know what I'm saying? So
yeah, no, I hear
right.
what you said.
Yeah.
Okay. Here's the Citigroup Economic Surprise Index, Brett. That's basically we've seen surprises on both sides, and that's why I think people are kind of confused and really don't know what to think of the econ data. Have you had any thoughts about the econ data that you've seen coming in? Like, obviously the slowdown in CPI has been notable; it still remains elevated. Jobs market still remains strong for the most part overall. Is there anything that's jumping out to you from the econ data that you've been seeing?
I kind of feel like right now is it's a little bit like, the data on what the world is like over the next month isn't so important to people because the drama is in the back half of the year. And you got to have really forward looking data points to understand. And so the credit data for senior loan officer was a big deal because that's talking about, creating a certain landscape of conditions that will determine the econ data we see in October. And so that's really important. And I think you really need to see those data points that are really, really anticipatory and forward looking, and data points that are really talking about the world as it is right now. I don't think the market's going to care a lot about one way or the other because there's really a big kind of binary drama in setting up for the fourth quarter of this year. And we're either in a recession or we have that soft landing with the Fed also cutting, or you've got these different scenarios that are so far apart in terms of their implications. And I don't think people are too worried about what the economy is going to look like in June, except to the extent that it's a harbinger of what we see during Q4.
All right. Moving along then. We've got the tail risks, bank credit crunch, and global recession. A little surprised that the bank credit crunch was still up there, but it shows that people are still a little concerned, not really buying into the language that this crisis is well under control. So that's one thing that I'll point out, and I'll point out another thing that kind of makes the banks interesting in me here.
It's important too, right? I mean, people who are answering the survey probably have pretty good information on that one in particular.
You would think they do, but it's also of interest too that if they are off, that to me suggests a possible big whip around in some of these regionals that have just been really
What if there are a
hammered.
whole bunch of other cockroaches?
I still think that we're going to be finding cockroaches left and right for sure. But meaningful ones that remains to be
systemic.
seen.
Right. So this should be. You're right. This should be
What
more systemically relevant, and that seems a tougher stretch.
Yeah, I don't see it as systemically relevant. Exactly.
Right.
It's idiosyncratic. I wouldn't necessarily
Right.
say that because that just suggests that First Republic and Silicon Valley were the only two banks because they were
Of course,
the
they do
ones
say
doing that. But
bank credit crunch and global recession.
yeah, I guess
I mean, what if
that's
it's
fair.
really just like one more bank goes under, but global recession?
It seems like a weird thing to kind of
You have to group
couch
together.
them
Yeah,
together,
right,
right?
exactly.
Because I mean, one would lead to the other
It
probably.
suggests a causality there, which seems like a tough stretch.
Right. Now, the second one, high inflation keeps central banks hawkish. We've been talking about that.
Yeah, right.
Third, geopolitical. We just talked about China and the U.S. meeting, so that's obviously a positive there. Systemic credit event, that really just stems from all the other stuff above,
Weird that
really.
it's increased though, right? Or it hasn't. It hasn't. It decreased.
It
Sorry,
hasn't.
my
It
bad. There you
decreased.
go. Okay, that makes sense.
Probably because most of the things went up to the U.S. debt ceiling, which popped on there at number 5. But that's so political that again, it just kind of points to my surprise that people are as concerned. But I guess you kind of have to be safe there.
But they're not
And
really.
they're not. Well, I mean,
They're
if you
not.
look at the debt ceiling, look at this here. But confidence in the debt ceiling resolution, and you can see looking from the yes to the no.
right?
And it asks, do you think the U.S. debt ceiling will be raised by the X date? Big pop up and no expectations there, Brett. So, I mean, to a certain degree, it kind of is still festering, right?
It's still
I mean,
festering, but
not the past couple of days, but
I still take my cues from the term structure for the VIX futures, and it's just nothing burger. Like there's when you see a big event that people are genuinely worried about, you see backwardation creep into the VIX forward curve for the futures, which is really rare, right? It's really rare to have a situation where, because always, just philosophically, I made this point before, but always the future 3 months out is more uncertain than the future 1 month out. Just always, for everybody, all the time, in every context. It's harder to predict 3 months away from now than 1 month away from now, except when you're in the markets and you have this big event coming and there's a date, and it's one way or the other by X date. And so typically
and
you'll see that.
what's funny too about that X date is that X date isn't even technically an X date.
Right. So it's a BSX date, but you could see that, I've seen situations like this where you're heading toward the Brexit vote, or you're heading toward some particular thing where, the rubber's going to meet the road on such and such date. And if it really has serious implications, you'll see it in the VIX term structure. You will see the 1 month out VIX futures contract start to price above the 3 month out VIX futures contract. And that's just, again, that's historically extremely rare. And it only happens when there's a series event where the world 1 month from now is more uncertain than the world 3 months from now because of some kind of event like this. And it's just not even like right now, there's just nothing. It's just crickets on the VIX term structure. There's no indication whatsoever that anybody sees this as anything legitimately important.
One of the interesting aspects that I've seen around the debt ceiling, Brett, was a recent argument that this would be a sell the news event. And I know we were talking briefly about it. The person's thinking on that was that basically we've seen liquidity improve because of the debt ceiling and the Treasury unable to issue debt. The general thought being if the Treasury, once the debt ceiling's raised, they're going to have to catch up on some of the other payments that are due. And in order to do that, they're going to have a very busy issuance schedule going over the final 6 months of the year. Some estimated up to 1 trillion in debt that the Fed's going to need to issue. And the thought is that that could dry up liquidity because banks would be forced to buy that treasury issuance, and therefore there'd be a little bit less on the lending front. I know you kind of doubted it because you were the mindset that the market should have had this priced in. Do you want to explain your thoughts on that and why you don't think that this is necessarily a sell the news event?
It's just bad marketing in a financial report. Like, sell the news is a phrase that has an unspoken first part, which is buy the rumor, sell the news. And it's just if you're just saying this is a sell the news event because of something that everybody can do the math on and predict right now, it's rife with the possibility that you're wrong. If that's what you're betting on, maybe it's just so arcane that it's nobody sees it coming, even though you just put out a research note from one of the biggest Wall Street houses in the world that everybody's now reading, and somehow it's not impacting anything. But there's no buy the rumor part of this story, so you're not getting everybody wrong-footed into some kind of shift in sentiment around something after it's no longer an issue. And also, everything that's in that argument is something that's completely predictable in advance and would be absolutely accessible to the market's ability to discount future events. So, and it's hard for me to see. It's possible that we're swept up in not caring about really arcane topics, and this is a little bit inside baseball for most people, and it's still going to have a mechanical impact on stuff that's going to trickle into stock pricing. I don't know, but it just seems like a tough stretch as an argument.
All right. Just moving along here. There was this debt ceiling slide I just want to show people. 79% expect a last minute short-term rise. This is according to JP Morgan. 4% expected to raise well in advance. So you can see if they were to do this tomorrow, no one's really positioned for that. Last minute long-term raise would be 15%, and then technical default only 2%. So this is a little less dour than the Bank of America outlook, I would say. All right. So yield curve outlook, Brett. This is the percentage of people expecting a steepening curve. And again, this kind of points to why the banks look pretty interesting. We talked about positioning here. Now looking at the yield curve, and we're going to show another slide here in a little bit in the tech versus bank positioning. But you got any thoughts on the yield curve, Brett?
Yeah, it's just like, okay, so this chart, along with the chart we saw earlier, it's one of those things where sometimes in the fund manager survey, you get a moment where you're like, if like you start to doubt the sanity of the people who are answering, because they all just said that they predict long-term rates to fall, right? And how do you, I mean, unless they're predicting a
much
huge
steeper
rate of
drop
like
in
a
short
whole
term,
bunch
right?
of cuts by the Fed, basically. Like,
Yeah.
the only way to get there is that but yet they're not predicting, the majority of them are predicting a soft landing, so it's hard to get there. So it just doesn't add up. Like this, how are you going to say that there's going to be lower long-term rates and a steeper yield curve with no recession? So
yeah.
That's just not a world that you're going to, unless CPI comes out at 0.4% year over year next time around.
Right. And then you'd see an immediate collapse at the front end of that curve.
You'd have to. That's it. So,
all right. Most crowded trades: long big tech, short U.S. banks up at the top. Short U.S. banks is actually even, or actually has declined since April.
Short
A little bit
US
of a
dollar.
short U.S. dollar is interesting given the move that we've seen in the
Given
dollar.
the long US dollar's been on the survey in the top 3 spots basically every month for like a year.
Yeah. And now it's short, and long T-bills popped on there too as well. And then we're seeing a big pop in long China equities as well from the past ones. So I've found this interesting, especially when you're looking at the price action in a lot of these Chinese ADRs. I mean, every time it seems they post earnings, I see a pop and then a aggressive rollover, like everyone's looking to run out from those stocks. So I am keeping an eye out on the ADRs just because I find them interesting. But yeah, I thought this most crowded trade chart was pretty interesting, Brett. So your biggest thing is the dollar, right? The short US dollar.
Well, my biggest thing is whenever I see this chart, I think we have the same conversation, and that is, gosh, I wish there was a conviction coefficient that came along with these answers, because the people are just sort of throwing stuff at the wall. Like, maybe, like maybe they're not prepared to answer this question right now. And it's just, what do you think? It's just the stuff that is, for the first two, it's just stuff that has moved the most is, I mean, the banks have gotten killed. Big tech has gone through the roof. And so therefore, long big tech is the most crowded, short banks is the most crowded. And I don't know. I don't like this answer in this survey, because you just don't get a sense of how much thought is put into these answers to me.
Right. Should I take it out for future sentiment and flow shows?
No, because I like making that gripe each time. So I want to keep having that little opportunity to express myself.
That next time I'll just have a slide with you in the middle finger, right?
You
after
could just have me going, yeah, Brett doesn't like this.
Here is another slide showing that bank versus tech, right? This is percentage overweight in banks minus percentage overweight in tech. And you get a fair idea, obviously, what's been outperforming for the last 20 years, right, Brett? But it's funny, you kind of get all these little incidences before major pullbacks, August 2006, May 2018, and February of 2022. So I suppose when you see people getting too long the banks, you should expect that the bankers are getting a little too willy-nilly with that inflow of money.
This is just like the growth versus value thing too.
Yeah.
I mean, it's the same chart. It's like during markets, it's one way. During corrections, it's the other.
Exactly. So, but again, it opens up in my opinion, makes the banks a little bit more attractive when you start seeing that. Bond allocation, same thing, right, Brett? I mean, during times of stress, you see
Sure.
people flowing into the bonds. You could see that little pop in March 2009, May 2023, same thing. Growth versus value, as you were just talking about, right? You just have that drop off going on here. Last couple of times we were down
Inverted.
at these levels,
Invert this chart.
inverted.
And yeah, it looks the same as 2 charts ago if you flip it over.
Right. So it just kind of highlights what we've been talking about with the positioning going on, certainly the breadth and everything like that. Um, I found this, I just kind of threw this one in corporate balance sheets. I thought it was important just because with the rise in rates, you're going to hear a lot about servicing debt now. That's going to be tougher. I found it interesting that how low of a percentage of people thought that corporates were over leveraged. From my understanding, I don't think that there's been a big move towards deleveraging debt that I'm aware of, but certainly a big drop off on that. Do you have any thoughts on that?
Yeah, I think everybody rolled it during the pandemic, right?
Yeah, there
We
was
got that
definitely a lot.
amazing coincidence of commercial paper rolling and the disease causing interest rates to go to nothing.
Yeah.
Well, I mean, that was amazing, really. Like that was because we
It,
were
it
a
was
year
definitely
before
a
we
get
were
out
like,
of
what
for
are they going
free
to
jail.
do? Like, how are they going to roll this paper? Hey, what if we have interest rates going up into that? It's going to be a disaster. And then there's, this weird event that crashes rates right at the point where you've got a 6-month window where half the corporate world is rolling all of their paper.
I'd like to see where the maturities are concentrated after that roll
Yeah.
for moving forward, because
Right.
there better be another event before that to get those
Oh,
rates
and maybe
down.
that's what happened. Are yeah, website conspiracytheory.com. Where did this disease really
Yeah,
come from?
yeah, we might have to. We
Corporate
might have to
bond
keep an eye out.
issuers.
Start wearing a mask if you start when we're getting close to those
When you start to
maturity
worry
deaths.
about commercial paper rolling over, get your mask on. I think
Put the
we
mask
figured
on.
it out. We finally
There we
figured it
go.
out.
There we go. All right, moving along. So we're just going to talk about earnings real quick, and then we'll call it a wrap. And I told you, Brett, I always get annoyed when I look back and I see a typo, and I just see one right here. Better than expected
Well,
so
it's your fault.
far.
You should
I
feel
know.
terrible.
I do. I do.
Good.
Coming in at year over year, earnings come in at minus about 3%. This was compared to expectations of a drop off of about 10%. Revenues, they've been beating by about 2% on average as well, which is a little bit better than expected on that front. Consumer stocks, they've seen a wide dispersion there. So definitely kind of works into the idea that people are cutting back spending in certain areas while other areas are thriving because they've been able to take advantage of prices. You look at your Coca-Colas, Pepsis, Walmarts of the world. And then on the downside, you got your Sonos and names like that have just been getting crushed. Home builders, they've been very impressive this earnings season. We saw the ITB hit a 52-week high uh, or, earlier today. Now, one thing that I would point out on those EPS beats, they were revised lower by 16% in front of the reports. So this is your classic better than feared, right? So while they are beating expectations, they were
They
greatly
were
reduced
managing
going into it. They
expectations.
were
Yeah.
managing expectations, exactly. Second half 2023 revisions, seeing less of that. Brett and I were talking about that in terms of the key for that 2024 valuation. Currently, 2023 EPS as a whole, the revisions have only been down about 4% year to date. Remember, during recessions, you're expecting about a 13% drop. So that is the one argument that earnings aren't priced for a recession, but so far we haven't seen a recession either when you're looking at the data. And the other aspect of these earnings, companies who missed were hammered. So just taking a quick look at this chart here, you kind of see companies that beat EPS and beat sales. Not much of a pop there, right, Brett? Just kind of on an absolute basis up 0.8%. up 0.8% relative, and then relative to the Q4 average up about 1.3%. So a little bit better, I guess you could argue, compared to Q4, but really it hasn't enticed a lot of money off the sidelines when people have beaten. At least this is T+1 in the day following. Then when you look at the beat EPS but miss sales, on average getting dinged on that, not a surprise. Missed EPS but beat sales, not as much of a hit on that, Brett, which I'm a little surprised about when you're looking at valuations. But look what happens when you miss EPS and you miss sales. You're just taken to the woodshed there. And you can see that on a relative basis. Just kind of shows the idea and really points to the breadth too, where people don't want to stick around in names that aren't working.
Or that aren't good at managing expectations.
That aren't
It's another
good
way
at
to look at
managing
it, right? Like
expectations. Yeah.
right now during the coming period, we need you to be good at managing expectations.
Yeah.
If you don't know what you're going to end up with, and it's a surprise, and that's what you do, I don't want to have my money with you.
Yeah.
Kind of.
Yeah.
Right?
No, that makes a lot of sense there. It makes a lot of sense. Let's see. And then we got down or EPS growth. That's saying a no landing here. So this is what is most likely growth rate for global EPS in the next 12 months. Most people are in that down to 0.5% range. Again, down 13% recession. About half of them are in that up 0.5% range, right? So that, or well, not half of them, about 20, I would say looks like 29 and 28% in there. Those expecting a steeper decline of 5 to 10%, running around 17% or so. Those expecting a big pop, that's only running about 14%. And then you get the 10% lower from here, that's only about 4%, 10% higher, basically non-existent. So people aren't positioned for that. So with that cumulatively on the earnings side of things, Brett, how do you kind of view this data?
Well, so first of all, how do you take the phrase "no landing"? Did you see the title?
Yeah, just kind of.
Is it soft landing or hard landing or no landing?
We're just going to chop around in these econ data.
Is that what you? So I would say hard landing is you beat inflation by a deep recession. Soft landing is you beat inflation and don't have a recession. To me, that leaves only one thing that no landing could refer to, which is you don't beat inflation. There's just no landing. You're still dealing with 7% CPI a year from now. Like, to me, landing is where inflation goes down from. Like, you go down and land. And you either do it with a recession or without a recession. So I have no idea how to interpret why he says growth expectations of negative 0 to 5% to positive 0 to 5% represents no landing.
Yeah, no, it's fair enough. I guess my point would be that
but it's still, bottled in.
You could argue that 60% of this survey were basically expecting earnings to be around break even, right?
Yeah, it's a normal curve.
There.
Sure.
So,
right.
So I guess that would be the no landing. So,
just doesn't make sense.
But now that we're at the end of earnings, we are starting to get the April end earnings, and they haven't been great so far. With Home Depot, Target, Walmart, but they've been having some good reactions. So a lot of people want to kind of look through what's coming down the road over the next couple of weeks, and more interested in looking ahead. I think the biggest thing for the second quarter of 2023 on the earnings front is simply going to be whether or not semiconductors do get through those inventory issues, or if we see them continue to hang around, because I think a lot of people are expecting a big rebound following a trough in semiconductors, and that's been a key driver for the market. And if that gets pushed out another quarter, then that could certainly disrupt some of the rally that we've been seeing. All right. So, Brett, we are at the end of our discussion here. We got about 12 minutes to the close. Do you want to wrap everything up in a nice tidy bow for us here?
Well, so nothing's changed, really. And that's been the theme of the market for 2 months. Nothing really changing. But the thing that we have that hasn't been changing is just this historic when you look at it, historic rampant underexposure to equities relative to historical standards. You look at retail, you look at professional investors, manage money the whole way. Everybody is just historically underexposed to equities. And anytime, and I've been doing this a long time, Gavin's been doing this a long time, we talk about this stuff. Anytime that's happened in the past, even if you can't imagine a positive future, you still get one for the markets. It's the only type of indicator that really seems to be something you can really count on. If you get these sort of historic levels of underexposure or short interest or over hedging, where it's just en masse, it's just consensus. It never works out in that direction ever. Even if you can't imagine why, it just doesn't. And so it's the reason why we do this show. It's the reason why we look at sentiment and flow, is we look at sentiment and positioning rather than what we think about the world. We just look at what people are doing and thinking and expecting. And when you get overwhelming one-sided consensus positions of expectations and positioning, it's really, really, really hard to see patterns resolve in the direction everybody is prepared for. And there's a really low bar for seeing the opposite happen. And we talked about the AAII data earlier, as Gavin said. Would you say since something like what was your? We've seen the negative bull
78 of the
ratio.
last 81.
What is it?
78 out of the last 81 weeks.
78 out of the last 81 weeks, we've seen a negative bull ratio. Like, that's crazy in terms of expectations. That clearly implies something about people's positioning right now. And if you start to get a rally, people, and you got 5.6% cash in large fund manager portfolios, which is way outside of historical standards. So there's just a lot of buying that's going to happen if this market proves that it can grind higher. It's hard to just get around that point. And so that's why we look at this stuff. And we've been talking for if you listen to the last 3 sentiment and flow shows, we've been saying the same thing. And we'll see where it goes. It's possible that the actual news flow turns so dark that it can battle back against that point. But boy, that's what people are already prepared for. So I think we just kind of stick to the same message in terms of what we're putting out there, which is basically, look, people are not prepared for an upside resolution, and an upside resolution is therefore the most likely resolution.
All right. Well said, Brett. So that is going to do it for us. We got just about 10 minutes to go to the close. I am going to shut down audio here and launch back up in a moment, and just take a look. There's not a lot expected in the after hours here. Deer tomorrow is going to be certainly one of interest for the cyclicals, that's for sure. So I'll pop back on, do a quick look around the markets here before we shut off for the day. But hey,
Powell.
Brett, yeah, sorry, I meant on the earnings front.
Yeah, no, I just mean,
but yeah, no.
When you think about tomorrow, Powell
yeah,
could obviously try to put an arrow into the balloon.
Yeah, Powell will definitely be a key aspect for tomorrow's
and Williams
trade. Yeah, I always feel Williams kind of gets shunned. I don't think he gets the respect for being a constant voter in the New York Fed president with a lot of insight.
He's
into
the
what's
Rodney
going on.
Dangerfield of the Fed.
Yeah. So Powell's and it doesn't matter.
Daily is Powell. So
he could come out and say, or I'm talking Williams, say whatever he wants. Whatever Powell says is going to override anything that Williams says. It's kind of how I view it. So
yeah.
But all right, Brett. Well, hey, thanks for joining us as per usual. I will be posting this to the replay of this to the website. I'll also post the slides for people to the website. So anybody got any questions on anything, definitely feel free to write in. But Brett, we will talk to you later.
You got it. Okay, thanks, Gav.
Okay.